Hi everyone, welcome back to Dollars and Cents, where our desire is for all to be financially savvy individuals. Today, we're diving into an important concept in finance called fractional reserve banking. It's a system that impacts how banks operate and influences our economy. Let's break it down step by step. So what exactly is fractional reserve banking? In simple terms, it's a banking system where banks are required to keep only a fraction of their deposits as reserves. This means they can lend out the majority of the money they receive. For example, if you deposit $1,000, the bank might only keep $100 in reserve and lend out $900. Before we can truly understand what fractional reserve banking is, we need to explore its history and how it came to be a key part of modern banking. Fractional reserve banking isn't a modern invention. It actually dates back to the Middle Ages when goldsmiths began issuing receipts for gold deposits. These receipts acted as a form of currency, and goldsmiths discovered they could lend out more money than they physically had in gold. Essentially, they were creating money by promising to pay gold that wasn't all in their vaults at the same time. However, this practice wasn't universally accepted. While it thrived in certain regions, it was often viewed with skepticism. Some authorities and customers worried that lending out deposits could lead to financial instability. Over time, many regions established regulations to curb such practices and ensure that banks maintained sufficient reserves. In the early years of the United States, fractional reserve banking was not the norm. Originally, banking was much simpler. Early American banks primarily served as warehouses for storing gold and silver, providing safekeeping for deposits. They issued notes that could be redeemed for these metals, but didn't engage in extensive lending. It wasn't until the late 19th century that the concept of fractional reserves gained traction in the U.S. This shift occurred as the economy expanded and the demand for credit increased. By allowing banks to lend a portion of deposits, fractional reserve banking facilitated more economic activity and growth. Now that we understand its origins, let's look at how fractional reserve banking operates today and why it's essential for our modern financial system. To grasp the mechanics of fractional reserve banking, we need to understand the reserve requirement. This is the percentage of deposits that banks are required to hold as reserves. This reserve requirement is set by the central bank and dictates how much cash banks need to keep in reserve versus how much they can lend. Central banks not only set the reserve requirement but also monitor banks, adjust reserve requirements, and influence interest rates to stabilize the economy. For example, during economic downturns, a central bank might lower reserve requirements, allowing banks to lend more and stimulate growth. Conversely, during inflation, they may increase requirements to curb lending. In the United States, the central bank, known as the Federal Reserve, is responsible for setting the reserve requirements for banks. These requirements can vary depending on the type of account held. For example, if the reserve requirement is 10%, the bank must keep $100 for every $1,000 deposited. This allows banks to create money through lending while maintaining a safety net. Now, let's explore how money creation works through this system. When banks lend money, they don't physically hand out cash. Instead, they create a deposit in the borrower's account. This is called deposit multiplication. Let's say you deposit $1,000. The bank keeps $100 and lends $900 to someone who buys a car. That $900 then gets deposited in another bank. This second bank keeps $90 and can lend out $810. This process continues, creating new money in the economy. So, what are the benefits of fractional reserve banking? First, it promotes economic growth. By allowing banks to lend more money, businesses can invest, expand, and create jobs. Second, it increases access to credit for individuals and businesses. This means you can get loans for homes, cars, and education, which can lead to improved living standards. But it's not all sunshine and rainbows. There are risks involved too. One major risk is a bank run. If too many people try to withdraw their deposits at once, the bank may not have enough reserves to cover them, leading to financial instability. This potential for crisis has historical precedents. For instance, during the Great Depression in the 1930s, mass withdrawals due to a lack of confidence in banks led to widespread bank runs, exacerbating the economic downturn. Similarly, the 2008 financial crisis highlighted the dangers of excessive lending and insufficient reserves. The inability of some banks to meet their obligations resulted in a loss of trust in the financial system and tighter credit conditions, slowing economic activity. These examples underscore the importance of maintaining a balanced approach to fractional reserve banking. Striking the right balance between lending and reserves is crucial for the stability of the economy. Now let's touch on some popular conspiracy theories associated with fractional reserve banking. One theory suggests that central banks, like the Federal Reserve, have undue influence over the economy and manipulate markets to benefit a select group of elites. This belief often leads to concerns about the erosion of democracy and economic stability. Another theory posits that fractional reserve banking is a deliberate scheme to create perpetual debt. Proponents argue that by allowing banks to lend out more than they actually hold, they artificially inflate the money supply, leading to inflation and making it difficult for individuals to escape debt cycles. Additionally, some believe that financial crises, such as the 2008 meltdown, are engineered events. They argue that these crises are used to consolidate wealth and power among the elite, who benefit from bailouts and economic policies that favor large financial institutions. Finally, there are theories suggesting that the move away from the gold standard and towards fiat currency, supported by fractional reserve banking, was a calculated move by bankers to gain control over the money supply and manipulate the economy without the constraints of gold backing. To recap, fractional reserve banking is a system where banks hold only a fraction of deposits in reserve, allowing them to lend out the majority. It's a system that can be said to have many benefits, but it's important to recognize that it carries significant risks. Events like bank runs and financial crises highlight the need for regulation and oversight. What are your thoughts on this important topic? What do you think about fractional reserve banking? Has it been a positive force in the economy, or has it caused more harm than good? Share your opinions in the comments below. And if you know of anyone who might benefit from this content, remember to share this video with them. Our desire here at Dollars and Cents is for every individual to become more wise in the world of finance. As always, don't forget to like this video and subscribe to this channel for more videos about the world of finance. Thanks for watching. We can't wait to share more financial tips and tricks with you in the next video. See you then.
I bet you didn't know managing money could be this easy. Subscribe now and get the latest finance tips and tricks straight to your feed. From saving smarter to investing better, we've got you covered. Don't miss out. Hit that subscribe button today.